Welcome in, folks. It's a rare buy one, get one free here today on the Reaction channel. 2 videos in one day. I got to get something off my chest, something that really bothered me. A Wall Streeter earlier today was trying to basically say that big tech stocks are very overvalued in this market. And I'm like, what are we looking at here? Because I'll take you through some numbers and some valuations, and we'll talk about what's actually very overpriced in this market versus what's actually a steal deal here, okay? Then we'll talk a little bit about something that was going on at X right now. Then I want to go ahead and react to this video. Dan Niles sounds very, very bearish on big tech also. Another Wall Streeter. It's like, oh man, it seems like, geez, it was just like, what, a few months ago? It seemed like everybody was so bullish on big tech, and now it's just like everybody's just, no one wants to own big tech all of a sudden. So I'm looking forward to react to that one. Dan Ives went on CNBC a few hours ago, talked about, big tech also, and we'll get into that. And then I'm looking really forward to getting in this video with you guys. It's about to get much, much worse, says Freight Waves gentleman here, in regards to trucking industry, what's going on right now, job losses that are coming, all that good stuff. So that's going to be a very interesting one to react to on a kind of a different subject, but an important subject. By the way, I appreciate everybody joining me as always. Thanks so much for being here. Hope you guys appreciate a 2-for-1 day in regards to buy one, get one free video. I don't usually put out 2 videos on the Reaction channel same day, but today's one of those days, and I was kind of feeling it. So appreciate y'all being here. By the way, busy times, busy week ahead. Also, pin comment down there today. I'll give you guys this free checklist. If you want this free checklist, can send it over to your email or, to your number or whatever. But basically, it's a free checklist on everything I kind of look for in a stock before I go ahead and buy it. That should help you guys out tremendously, okay? Alrighty, so, by the way, thank you everybody to smash the thumbs up button. Not sure if I said that or not, but I appreciate y'all that are here and subscribed. You want to know where the real ripoffs are in this market? It has nothing to do with big tech. I'll show you where the real ripoffs are in this market. Look no further than stocks like Walmart, stocks like Costco. That's where the real ripoffs are in this market. 37 forward P on Walmart, 52 forward P on Costco. Meta's at a 21. 21. Here's the difference between a Meta and a Costco and a Walmart. There's a lot of differences, okay? One, Meta's business model's a million times better than those companies. Those companies have to ship massive amounts of products all around. They have huge wage pressures always on them, right? All of a sudden minimum wage goes up, and then they have to go up on their workforce. And then if labor's too tight, then they have to give an extra $1 or $2. And that makes a huge financial difference. Customers are extremely price sensitive if they go to buy toilet paper and paper towels and cleaning supplies and all this stuff that these companies sell, right? And so if one has it cheaper, they're going to say, okay, I'm going over here. It's extremely cutthroat. The business model of Meta is night and day better than those companies. Secondly, growth rates. Meta's growth rates are way better than Costco and Walmart, right? Next up here. Oh my gosh, let's think about this for a moment. Is there any serious competition for Meta? What are you going to go to if you don't go to Facebook? Nothing. There's no Facebook other product out there. It doesn't exist. If you don't want to use Instagram, what other product do you use? There's nothing. The use case of Instagram and Facebook, there's nothing else that exists that's anything like that people use. TikTok's a way different thing. Netflix is a way different thing. YouTube's a way different thing. X is a way different thing. There's no replication of that. However, if I want to go buy a roll of paper towels right now, I got a million different options. I go to the dollar store, I go to Target, I can go to Walmart, I can go to Costco. There's no replicating Meta's business model. You don't just build another Facebook. It doesn't happen. It's impossible. You don't just build another Instagram. If it was so simple, you just build another Facebook or Instagram, there'd be a million different Facebooks and Instagrams, and look there's none, right? So Meta's night and day better across the board, and yet look at where Meta's valuation is versus a Costco and a Walmart, right? Google McDougal, oh my gosh, guess what? Far better business model than Walmart and Costco. Way better balance sheet. And look at Google, 16 forward P versus Walmart's a double up of that, and Costco's a triple up of Google? Come on, man. Give me a break. Walmart and Costco would gladly switch business models with Google tomorrow if they could. It's not even close. Not even close. Are you kidding me, man? You got to be flipping my flapjacks. If we want to go ahead and take a look at Amazon, right? Far better growth in Amazon than Walmart and Costco, right? Far better business models, too, because they actually have the AWS side of their business, which is insanely profitable, sort of profits Costco and Walmart couldn't even imagine. And additionally, Amazon's already won the next 10 to 20 years in regards to delivery of products to your home. They already beat Walmart and they already beat Costco at that game. So Walmart and Costco are going to be fighting over who's number 2 in delivery of e-commerce products to your home. That's what they're going to be fighting over, right? Amazon already won that war for the next 10, 20 years, next couple decades at least. So, and then Amazon has its huge advertising business, which is creme de la creme. So you get better growth rates, cheaper valuation, right? Are you kidding me? And the business model is way better. Like, that's the steal deal, Amazon. Like, are you kidding me? And we could go through the whole list of these big tech stocks, and you'll find time and time again, the steal deals are actually in big tech now. I know it was a popular thing for people to pick on big tech and say, oh, valuations are high and people are concentrating in those positions. The real issues in the stock market are stocks like Walmart and Costco, not stocks like Amazon and Meta and Google and those sorts of stocks. I mean, those business models are night and day better, and they trade for cheaper valuations, and they have way better growth rates. And they have way better next, 5, 10, 20 years ahead. So, wild times, but don't let anybody trick you into thinking like big tech's not a deal here. No, it's a great deal. Doesn't mean the stocks can't go down in the short term or whatever, right? But if you want to say a big tech that we could talk about this and looks, very rich, I have a stock for you. I'll show you. Here it is, okay? Tesla. I mean, yeah, if you want to make an argument that Tesla looks really expensive, sure, 124 forward P, 2-year forward P, 80, like, okay, Tesla. But there's a big difference between where Tesla's valued and where a Meta's valued, a Google's valued, Amazon, those sorts of companies, right? And also the sort of growth rates those companies and the sort of business models and the margins and everything like that. So, come on, man. Next up here, since we're on the subject of Tesla, I thought it would be worth addressing this. Joseph Carlson posted this on X a couple hours ago. He said, it's crazy. Jeremy was one of the earliest public investors in Tesla, held for over 5 years. He was one of the biggest advocates and sold it for a large profit. But despite that, Tesla community attacks him like a bunch of vultures because he's no longer in it. And yes, it's kind of like getting out of a gang. Like, once you join, you can't get out or something like that, or the mafia. It's like once you're in, you can never get out. But, and I posted this. I said, well put, Joseph Carlson. I said, funny thing is I'm so at peace with the decision. I made insane gains in the stock. I'm very thankful and moved on. All the best to Tesla shareholders, right? And so, if people can't get over that, like, that's their own decision, but I'm over it. Cool, and if the fundamentals of the business ever get a lot better and the valuation's at the right price, I'll buy the stock back. Like, it means nothing to me. That's easy peasy lemon squeezy. And so, I appreciate that. And, it's just been the way it is in regards to that. Alrighty, let's listen to Dan Niles.
Investment management. Dan, of course, was a semiconductor and computer hardware analyst during the dot-com bubble, a famed one, in fact. Dan, always great to see you. Thank you for joining us. I know at the beginning of the year, you took a very defensive stand relative to some of, other market participants. Cash was your best position. You weren't in any of the Mag 7 names, and that seems like an amazing call at this point. Are you closer to reallocating to Mag 7 at this point? Or no, there's still a lot more that you need to see?
So I think you need to look at it from a very big picture standpoint, which is if you think about what drives the S&P 500, there's really only two things, right? It's multiples and it's earnings. Right now, S&P earnings are forecasted, official forecast is up over 10% year over year. I sincerely doubt that's going to occur. That number's probably close to low single digits and maybe flattish. So that's coming lower. Second piece is obviously the multiple. And you've got the trailing PE for the S&P at 23 times. Coming into the year, we said, with inflation between 2.5% to 3%. The average is normally 19 times. I don't think we're going to get a recession, but if you do, that multiple is closer to the mid-teens. So, the multiple's got to go down. So then you move to the Mag 7, which is the question you asked me, Melissa. And if you look at it dispassionately, the numbers for 4 out of the 7 Mag 7 have been coming down since the middle of last year. And
so what he brings up here is that's a good point, and that's an important point. But here's what I'll say about this, okay? That's an important point if you're trying to trade in and out of these stocks and you're trying to play them from a swing trading perspective of like be in this one for the next 6 months, 12 months, blah, 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 okay? At the end of the day, if you're a long-term investor, that means not a whole lot. As long as the next 3, 5, 7 years, the growth rates are around what you think they're going to be around, which is why you should always average your growth rates out. Because if you're thinking about a company over the next 5 years, you have to think like there'll probably be a recession at some point in time. The business model will probably go through a tougher time at some point in time. So you have to kind of average a growth rate. So whenever I'm using 1000xstocks.com and I'm running my valuations, always average it out over time. And so if I'm like, this company might grow revenue sometimes like 15% a year, but some years they might only grow 5%. Then I might average it out at 7% or 10% or 12% or something like that, right? And so if you're a long-term investor, the fact that earnings estimates have been coming down and people have been getting less bullish on the earnings estimates of these companies doesn't mean a lot for you over the long term, but it does certainly mean something short term in terms of a swing trading perspective. Now, the other important thing you got to understand about this is at some point this is going to flip. This is going to go the other way. And then earnings estimates start getting a little higher and a little higher and a little better and a little better, right? And so when does that flip happen? My guess is probably in the next 1 to 3 quarters. So at some point in the next 1 to 3 quarters, we'll flip that, and then analysts will start bringing up numbers rather than keep decreasing them, right? What is that going to be? Very bullish for stocks in the short term whenever that flip occurs, right? But you got to let that kind of play out. So the short-term game is going to be what the short-term game is. For 99% of the people watching this video right now, you're in this for the long term. You're trying to think about where's Meta's earnings going over the next 5 years. You're trying to think of where's Palantir's earnings going over the next 5 years, not where it's going over the next 5 quarters and the next 2 quarters.
Is Microsoft, Amazon, and Apple. And then Tesla's numbers have been coming down since the year before, but that's obviously a different beast. So estimates have been coming down. And if you look at the Mag 7, when they reported their calendar Q4s, 6 of the 7 companies had their forward revenue estimates go down. That's before all of this tariff stuff started to kick in. So things had already started to weaken on a fundamental basis. Now, the good news, as you said, is if you look at NVIDIA, the stock went down 49% from its peak to its trough. Tesla was worse. And so a lot of these things have corrected. And by the way, the 4 companies that are going to report, I think all of them are going to beat revenues, beat EPS, beat margins, and probably that should be good enough. But then you look at Google and you go, stock's up less than 1% after having done all of those things.
No.
And so you wonder, are investors really thinking forward to the next leg of this, which is, that's because demand has been pulled in and we're going to have to pay that back sometime later this year. And so I'm going to actually start to think a little bit further ahead.
Yeah. Okay. So what do you do if you're an investor, right? And let's say earnings do deteriorate over the next, 3 quarters. Let's just say for the remainder of the year. It's just these companies' earnings get worse and worse and worse and worse, right? Well, you have to look at it from a perspective of where are earnings going to be on average over the next 5 years, not over the next few quarters. Because you got to understand, you could make a huge mistake and not buy anything whenever you're in a tougher market or recession. You could have looked at the market in 2020, right? You're going through Rona, and worldwide economy is shutting down, earnings are tanking, and you could have assumed that was going to be the earnings backdrop for the next 5 years. Obviously, that's not what it's been, right? So we would have made a huge mistake. If you started when I started, the great financial crisis. Like when I first started in the market, that was the end of 2008 going into 2009. Basically, almost every single company's earnings were complete garbage, complete dumpster fire. Companies were missing earnings at the fastest clip ever in history or something like that. It was ridiculous. It was awful. I didn't really even understand what the market was and why all this was bad at the particular time, right? I just knew everything was bad. But I could have got in the market and assumed that was just going to continue forever and ever and ever. Obviously, it didn't, right? And so you have to think about how are, and same thing in a boom cycle. Let's say, for instance, a lot of these companies, the big tech companies specifically in 2021, their numbers were insane because they were coming off of ridiculously easy comps. Everybody was forced to be home. And so a lot of those big tech company earnings were ridiculous, right? Now, you look at that and say, that's the way it's going to stay, right? No, obviously not. They were coming off of super easy comps because of 2020. And then, folks were flush with stimulus and all this stuff. So you couldn't assume those growth rates were going to be the growth rates forever. Meta was posting some quarters, if I recall, their revenue was up 30+%. And you could have extrapolated and thought Meta's revenue is going to be up 30% plus a year every year. No, that was unrealistic as well. So you have to average it out over time. Think about what happens to the company in bad times, good times, and what's kind of the average range. And then you run your bull case, your base case, and your bear case on a company. And so, for instance, if I was running my projections here, right? So let me show you. Because this is important. Everybody does this. If you don't use 1000xstocks.com, use your own software, make your own spreadsheet or something, right? And we also have the advanced projections feature if you're looking to go really in depth in regards to this and factor in share buybacks and all that stuff. But, the way you want to do it is, let's say I was running numbers on Meta, right? Because we were just talking about Meta. So I'd want to think about really in depth on what I kind of thought a bull case would be for Meta. So a bull case for me for Meta would be 15%-ish revenue growth per year, right? And then I would think base case, probably take that down about 3 percentage points, probably take it down to about 12%. Bear case, probably take it down to about 9%, right? And then I do the same exact thing for my net income. Okay, net income, bull case, probably 20-22% per year. Base case is probably 17-18%, somewhere in there. Bear case would probably be about 14%. And so boom. And then you can run your projections, you can run your PE ratios and things like that and kind of figure out, is this company a good deal today based upon where their earnings are going over the next 4 or 5 years? And that's what's important. So I'm putting you guys on some game there so you know how to actually value these companies and don't get caught up in all the short-term mumbo jumbo here, because you can get caught up into that, right? And so, important.
So where do we focus our attention now with Alphabet? What is the message or signal there?
Yeah, look, I think there, when it comes to advertising, I think we're going to see a rebound. That's something I think we're going to see when it comes to Meta. And overall, it speaks, I think, a theme for the week when it comes to,
and it's important. Let me address this real quick. Google only going up 1% or whatever it was after they beat everything across the board. What's my opinion on why that happened? Twofold. One, people are still concerned about ChatGPT. What does that mean for the business? So you didn't get enough clarity to know what the long-term ramifications of that are. Two, it was pretty much the earliest big tech company to report, other than Tesla, obviously. And so people are kind of concerned about the Qs and big tech in general this week. So people aren't that excited to just jump in Google when you've already been in a very scared market, right? People are very I don't know, so no one wants to run into Google, bid that thing up 5, 7, 10% on their earnings, then get slapped in the face this week if big tech earnings don't come out good, and next thing you know, Google gives up it all, and you're like, dang, I just missed 10% there. Remember, a lot of the market's driven by short-term traders, people that are playing this game from a 6-month perspective, 3-month perspective, 1-month perspective. And so for them to all of a sudden lose 10% is everything. For me, I don't care. Google McDougal is a great buy at 100 and whatever 60. It's a great buy at 150, 140. Which, by the way, do I have Google? Oh, I need to add Google McDougal onto the stocks I own list. It looks like, huh? We're gonna add Adobe on there too. ADBE, new stock I own. We're gonna add that baby, and then we're gonna add Google McDougal officially onto the stocks Jeremy owns list. And so Google, it's a buy at 162, it's a buy at 152, buy at 142. You know what I mean? It's just ridiculous. But people get caught up in all this game. You as a retail investor, don't get caught up in that crap, man. Just focus on the long term. You'll make a lot more money and be a lot less stressed out.
Advertising, cloud, and AI. Really, the key focus is, what does spending look like? Is CapEx holding up? We believe it is. I think big tech this week is going to be more of a confidence booster rather than putting gasoline on the fire in terms of the fears. I think that's the important thing we're going to see from big tech. I think Alphabet was just sort of a little preview of what we're going to see this week.
We spoke to an investor last hour who said he's still cautious on big tech and basically still thinks that, there's a soft patch coming in the economy and that he's kind of hiding out in some of the insurance names and a little bit more of those steady Eddie spaces. So what would your response to that be?
I would have said, if I go back a few weeks ago, you don't know where this is all going. I can tell you from all of our survey work and everything we've seen in the field, AI spend holding up like Rock of Gibraltar. When it comes to the cloud, in terms of overall spend, I think there's parts where it's actually accelerating. Now, look, uncertainty is there. And that's definitely going to create, in terms of guidance, huge sort of goalposts that they give. But big tech, even though tariffs, it's not stopping the AI revolution.
Well, this is exactly what I've been telling everybody last year I told them, get ready. Everybody's going to spend even more money next year. The issue you're going to have with this spending is next year, 2026. It's always been the issue. Is I'm thinking there's a decent probability that companies are going to slow that rate of growth massively, as in flatline it. Maybe some companies might even decrease slightly. That's a huge deal because that's going to create a big wave worry kind of around NVIDIA. And that's why NVIDIA is having trouble really getting that stock going. I mean, you're looking at NVIDIA. NVIDIA is what, 107 or so? And it's like, you remember back last summer, NVIDIA was like 150 plus, was it not? Right? And, NVIDIA just can't get out of its own way. It's 108. Literally, like last summer, that stock was pushing 150 plus. And, it's just been tough sledding, and it's going to remain tough sledding, as I've told people a million times in regards to that company, because the worries around what does spend look like next year. And then what does that mean for NVIDIA's numbers, right? Then you add on AMD, obviously ramping up chip production in a massive way with the MI350s. I mean, that's a huge deal. And then next year at the MI400
was notable over the weekend. We always talk about how people kind of gathering their thoughts over the weekend. And Michael Darda, who's a kind of a macro strategist and economist, but he'll make tactical market calls. And he said he's experienced what I've experienced, which is AI has gotten so much better over the past year. Like I would talk about, I now use it all the time. In the past, it was more just kind of a goofy tool. It just wasn't as good. And he said, I'm changing my investment thesis from bearish on tech to bullish on tech and on the AI pieces of it, literally as a result. Because he's like, I now see how this is going to bear fruit.
Yeah, and I think like what he's talking about is what enterprises are seeing. And that's why, and we've talked about in our survey work, like they can't all of a sudden just halt projects. Yeah, exactly. Because then you're at the back of the line. And I think when it comes to Microsoft, when it comes to Amazon, especially on the AWS piece, when it comes to what we're going to see, in terms of Meta from an advertising perspective, it's all about this AI revolution. And even though tariffs has created massive uncertainty, we'll see that when it comes to Apple in terms of, from a production perspective, software, that's a safety blanket. Hyperscalers, the spending is going to be there. And I think that's really going to be a big theme this week for big tech.
And so for me, for AMD, let's talk about AMD. The fact that I believe, and I've explained this many times, but I just want to explain it again to folks. For AMD, in regards to my belief that a lot of these big tech companies are going to hardly increase budgets in 2026, they're going to probably flatline it or so. Does that mean not good things for AMD? The answer is no. Like AMD is still going to be just fine in regards to that because they're a very small piece of the AI market and they're a growing piece into that market massively over this next several years. And so AMD is going to be growing regardless. Now you could say, maybe this means tougher numbers for NVIDIA, or very slow growth rates for 2026, 2027. And that's what I've talked about this whole time. That's definitely a very realistic possibility. But in terms of AMD is going to be growing, in my opinion, at a very strong clip, not only this year, but next year, 2027, 2028, regardless of kind of where budgets go in the short term, on a year-to-year basis. Alrighty, next one up here, FreightWaves. Looking forward to hearing from him.
Joins us now. Craig, great to see you. We've heard of the reports of just people not ordering anymore, companies not ordering anymore, cargo ships being stranded. How bad is it right now?
Well, it's about to get much, much worse. So certainly it's true that companies have canceled orders. A lot of these orders they had in place up to a year. And so they were certainly expecting some level of tariffs, but not what we've seen right now. So most people expected we would see, up to about 20% tariffs on China. Now we're looking at something that's completely different. In fact, the margins just don't make sense for them to import because they're looking at a potential 145% tariff. So there's been a lot of cancellation of voyages to the United States, and the amount of freight that we're expecting over the next 2 weeks to drop off on a year-over-year basis is down 35% in terms of imports. And this is going to show up in the domestic economy pretty soon. We're about anywhere from 2 to 4 weeks out of seeing the trucking industry lose an enormous amount of its volume, probably around 6% of total trucking volume around the United States is actually going to drop off simply because we don't have the import activity happening.
Mm-hmm. And then, of course, there's
you know what I think about when I think about that? I think about that brings inflation even more further down, because at the end of the day, I wouldn't want to be in the trucking industry if volumes are going down like that, because it's going to get even more competitive. In the trucking industry, honestly, I would say for the really since 2023 has been brutal. Trucking industry has been very brutal. It's gotten a little better in the past year and a half because fuel prices coming down, but it's been in kind of a brutal spot. Like, man, trucking industry was on fire, really from the back half of 2020 into 2021 and into 2022. But geez, now with, in 2022, they started getting hit with fuel prices kind of being an issue, but it wasn't really volumes. And then 2023 was kind of tougher, certainly for the trucking industry. Prices started to come down massively in regards to what they could charge. Then 2024 was kind of like stabilization a little bit, but then also helped by fuel prices. Woo! Going to be kind of a little bit of a tougher time short term in regards to trucking industry if they're talking about volumes are going to drop like that. And it doesn't affect everybody in trucking, but it affects a lot of the folks that are, moving product across the United States and maybe are on a bid type process. And so, but that does, at the end of the day, like inflation will be lower because of that.
There's the ports. And then you're freight wave, so you're focused on sort of the cargo aspect of it. But then, of course, the ripple effect is into the stores, into the businesses where there will be layoffs as well.
Yeah, there's 500,000 people that work in logistics in Southern California alone. There's 9 million people that work across the country in logistics. And all of these jobs are going to be impacted in some way by the slowdown in import activity. And so we're expecting there to be mass layoffs in the logistics industry. And also, as Apollo reported, this is going to show up and impact retailers. Retailers are simply not taking inventory of products that they have pre-ordered, and they're certainly not ordering new products. And we will see inventory stock out sometime in late summer, probably as early as late June, but certainly in July and August. And I think most consumers will notice it when they go to purchase their back to school items.
Okay, that gentleman was talking about mass layoffs in the industry. Do I think there's going to be mass layoffs? The answer is, in the short term, no. Longer term, we'll see. Or medium term, we can call, we'll see. And here's why. If you're running these sort of logistics companies, the last thing you want is to make a drastic decision because volumes are down short term. You lay off a bunch of your employees, right? And keep in mind, these companies usually do not run fat. They usually run very lean because they don't have the sort of margins in this industry, in the logistics industry, in the trucking industry, anything in relation to this. They don't usually have the sort of margins to have a fat company. This is not freaking, some Silicon Valley tech company that just gets billions of dollars thrown at them. These companies usually run very tight. But the last thing you want to do is make a drastic change. And then let's say the volumes come right back a month from now or a few months from now. And all of a sudden you laid off, 15% of your workforce, 25% of your workforce. And then the volumes come right back. And then you're in a rough position because then your competitors are going to take market share in that because you're not going to be able to hire back fast enough. It's going to create a whole mess. So until these logistic company, trucking companies are more clear about where demand's going over the next year, they're not going to make drastic changes in the short term. They're going to wait, kind of see, do volumes come back? If volumes don't come back, then that is when they'll go ahead and announce layoffs. And we're cutting 10% of our workforce, 5%, 20%, 30%, whatever the number is. But you got to be more clear. Because otherwise it's going to cost you way more money to lay off a bunch of people, then try to bring some of those people back or all those people. It's a whole mess. And you create a bunch of, obviously, problems in your company, your culture, a bunch of other things. Okay, so it gets messy quick. So that's what will happen there. Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. Thank you for smashing that thumbs up button. Additionally, free access to my checklist before you buy your next stock. That will be pinned comment down there, enter your name, and I can send it over via email or text, and you will receive that. You will love that, okay? Alrighty, guys, much love and have a great day.